Hey guys, it's time to wind down. Tonight, we'll gently step back into 1961, a year when Warren Buffett was still in his early 30s, quietly building something extraordinary. We're not here to chase stock tips. We're here for something gentler, a few thoughts, a little wisdom, and maybe a sense of peace. If you enjoy this kind of quiet space, feel free to like and subscribe, but only if it feels right to you. Let me know in the comments where you're tuning in from and what time it is right now. It's always amazing to see this little community coming together from across time zones. So take a breath, turn down the lights, and let's begin. Tonight, we're stepping into 1962. I want to bring you back to a note I shared with my partners earlier that year. Something I called a prediction. Now don't worry, this isn't going to be one of those frantic forecasts. I've always stayed away from predicting the market, and I still do. But back then, I felt it was only fair to share what I believed was likely, not with charts or fortune telling, but with quiet conviction. I told my partners, I don't know where the market is headed next year. No one really does. But over the next 10 years, there'll be up years, down years, and everything in between. Some years, the market might surge 20% or more. Other years, it might fall just as hard. And most years, somewhere in the middle. I don't know the exact sequence, but I also don't think it matters that much. Not if we're thinking like long-term investors. If I had to guess, the Dow might return 5% to 7% annually over time when you include both price gains and dividends. And honestly, if someone's expecting much more than that from the general market, they may be setting themselves up for disappointment. That's why I told my partners, our job isn't to beat the market every single year. It's to quietly and consistently build advantages over time. Let me put it this way. If we lost 15% in a tough year, but the Dow dropped 25%, I'd actually feel better about that than if we both rose 20% in a strong market. Strange as it sounds, it's not about bragging rights. It's about long-term outperformance, step by step. And I ask them not just to agree with me in theory, but to feel it deep in their bones, not just up here in the head, but down here in the gut. Because here's the truth, the way I invest, we tend to do best in flat or declining markets. And when things are roaring upward, we might fall a bit behind. That's okay. If we can average out to beating the Dow by 10 percentage points a year over a decade, I'll consider the result deeply satisfying. Now just to give some shape to that, if the market were to drop by, say 35% or 40% in a bad year, which I believe is quite likely at some point in the next 10 years, then ideally, we'd only be down about 15% or 20%. If the market stays flat, I'd hope we could be up 10%. And if the market jumps 20% or more, we'd likely rise, but probably by less. The outcome of this approach, stretched across time, could mean something remarkable. If the Dow gives 5% to 7% annually, maybe we'll land somewhere closer to 15% to 17%. Of course, these are just expectations. They may turn out to be too bold. And someday, when people look back from the future from 1965 or 1970, I might look very wrong. But I've always believed that my partners deserve transparency. Even when the future holds more uncertainty than clarity, what I can promise is that in any given year, we might have surprising ups or sobering downs. That happened in 1961, and honestly, it went in our favor. But that won't always be the case. Still, we walk forward, one careful step at a time. Let's continue drifting through the past thought. It's now the middle of 1962, and things in the market are shifting sharply. Between the end of 1961 and June 30th, 1962, the Dow dropped from around 731 to 561. That's a decline of over 21%. If you are holding a basic basket of stocks, the loss would have felt steep even with a few dividends cushioning the fall. But here's where things get interesting. Buffett saw declining markets not as disasters, but as opportunities. Like a calm captain steering into a storm, he welcomed these moments. You see, his strategy was never about racing ahead during bull markets. Instead, it was about losing less when everyone else stumbled. That's where long-term advantages began to compound. During this rough first half of 1962, Buffett's partnership declined only 7.5%, far less than the market's 21.7%. That's a gap of over 14 percentage points. It's as if while the market was tumbling down a steep hill, Buffett simply took a careful step down a small slope. Of course, he reminded everyone, don't get too fixated on short-term numbers. Even 6 months of great performance might just be luck. And next time, that luck might run the other way. Then, Buffett turned his attention to mutual funds. He believed most investment managers, whether in big firms or managing individual accounts, tend to move right alongside the market. No better, often worse. To show this, he compared his results to the largest investment funds of the time mutual and closing day alike. The top mutual funds in the country, with billions under management, barely outperformed the Dow over 5 years. Some did worse, especially in that tough first half of 1960. One fund dropped 23%. Another, down 25.4%. And those growth funds that were so popular, they got hit the hardest. The very ones that shined in earlier years, like Fidelity, Capital, and Putnam Growth, fell by over 30%. Buffett gently pointed out the irony. Those earlier gains attracted waves of new investors, but it was the newcomers who ended up feeling the full pain of this decline. A reminder that success, when chased, can become a trap. Still, Buffett didn't bring this up to boast. Instead, he said, "Look, this is the average performance of well-paid professionals managing enormous sums. If you want in this partnership, you'd likely be investing through something like that. That context matters." Now let's talk about your actual investmental piece of the partnership. If you didn't withdraw money during the first 6 months of 1962, your equity declined by just 7.5%. But if you were withdrawing monthly income as some partners did, your equity would have dropped closer to 10.5%. That's because, in addition to the market losses, some capital was withdrawn in cash along the way. Buffett even gave a gentle example. Imagine you started the year with $100,000 in a partnership. If results end up at minus 7% and you also withdrew $500 a month, by year end, your investment would be worth about $87,000, and future monthly income would adjust accordingly to around $435. No judgment. Just quiet math. Dottie also reminded everyone these numbers don't apply to money you sent in during the year that earned a flat 6%. Those funds weren't affected by market swings. Lastly, let's gently summarize some longer-term numbers. From 1957 to mid-1962, the Dow rose a modest 37%. Some mutual funds managed to match that, but not all. Meanwhile, Buffett's limited partners saw their money grow by about 160%. Quiet, steady, and compounding. That's the kind of performance that doesn't shout, that it whispers. The gentle flutter of annual paperwork has arrived. Enclosed, you will find 2 copies of an updated partnership agreement for 1963. One includes the general provisions. Please keep that one with you. The other, a single-page version, should be sent back to us. There are no big changes this year, just a few tweaks to the wording here and there, mostly to make things clearer. Most of these changes are in the General Provision 5, which was paragraph 7 in last year's agreement. Instead of sending a separate amendment, we combined everything into one full document for simplicity. Also included are 2 commitment letters, one for you to keep and one to return. Here, you indicate if you wish to add or withdraw partners as of January 1st. We'd appreciate receiving the agreement and the commitment letter by December 1st, but don't worry if your plans change later. You can update your commitment letter anytime up until the end of the year by simply contacting me. If you choose to withdraw, payments will be made soon after January 1st. For any additions, please send them by January 10th. Payments made in November will be treated as advance payments and will earn interest at 6% until the end of the year. Please remember to have your signature on the partnership agreement notarized. If you're in Omaha, you're welcome to stop by our office for notarization. Also, kindly indicate on your commitment letter whether you want to receive monthly payments in 1963. A quick reminder, these monthly payments aren't guaranteed earnings. They're a convenient way to withdraw regularly. When we earn more than 6%, they come from earnings. If not, they come from capital tax information for your 1962 return, will be ready by January 20th. If you need an estimate earlier, just ask, and I'll give you a rough idea. We'll also send a short tax letter in late December. Now, a quick update on how we're doing so far in 1962. Up to October 31st, the Dow Jones Non-Industrials showed a loss of about 16.8%, dividends included. We'll value our controlling interest in Dempster Mill. Manufacturing the same way as last year, applying discounts to inventories, receivables, and fixed assets based on what we think could be realized quickly. The big highlight of 1962 has been converting much of Dempster's assets to cash at nearly full value. For example, inventory dropped from $4.2 million last year to about $1.9 million this year, cutting the discount by roughly $920,000. I'll share the full story in the annual letter, but applying those same discounts again should give us a year-end value of at least $50 per share. To put it simply, while last year's cash and liabilities stood at about $166,000 and $2.3 million, respectively, this year we expect around $1 million in cash and investments, with liabilities down to $250,000. The outlook for further improvement in 1963 looks promising, and we expect a much larger investment portfolio at Dempster next year. With Dempster valued at $50 per share, our overall gain to October 31st before partner payments is 5.5%. That's 22.3 percentage points ahead of the Dow, one of our largest leads ever. About 60% of this came from other portfolio investments, and 40% from the increase in Dempster's value. I want to remind everyone that these results are unusual and won't happen often. Much of this success comes from having a large part of our funds in controlled assets and workout situations rather than the general market, especially when the Dow was falling sharply. If the Dow had gone up substantially this year, our relative results might look quite different. This performance doesn't reflect any market timing skill on my part. I don't try to predict the market, but rather the consequence of being invested in different categories when prices were high. If the Dow had kept rising, we might have been left behind. We fully expect there will be years when our approach doesn't even match the Dow, though over the long term, I believe it will. Otherwise, I'd just buy the Dow and call it a day. To wrap up, I don't want anyone to think this recent year's strong performance will simply repeat. I expect future advantages over the Dow to be smaller on average. Please, if anything in this letter or the agreement is unclear, don't hesitate to reach out. We've got secretarial help and new equipment ready and want to make sure everyone understands everything. There's no prize for being the last to return your agreement and commitment letter, so please send them in as soon as you can. Remember, you can update your commitment anytime by postcard or phone call. We just want to get most of the work done before December 31st, so we can focus on the audit, tax info, and year-end tasks. Let Buffett's calm voice echo into your sleep. You don't need to know all the answers tonight. You just need to stay curious and kind to your future self. Good night, and see you next time when we return to another year, another letter, and more quiet thoughts from Warren Buffett.